Over the last few years, we've seen asset prices skyrocket, which has some people asking if we're in bubble territory. While it's sometimes difficult to tell, we as real estate investors need to develop a strategy that will bode well in changing environments. Today, we're going to be discussing market timing, the dwindling real estate inventory, and how to think about the fact that interest rates will be going up over time. Hey House Stackers, welcome to episode 30 of the Stacking Houses podcast, where we're helping working professionals create a solid plan B, a side hustle of passive streams of income through real estate investing. I'm your host, Damon Santa Maria, and my goal for each show is to provide you with some practical and inspiring information so that you too can create a solid financial plan for yourself. So to help you on your journey, I want to give you our beginner's guide to getting started in real estate, which outlines all of the key steps that investors need to take to acquire your first property. And you can pick this up simply by going to stackinghouses.com/beginner. And while you're there, be sure to check out our blog, my free book, as well as a great training on where my business partner Jim and I are finding great deals in today's landscape. So today we're going to review timing the market in real estate, which is certainly different than timing the stock market. The stock market is a much different animal where entire fortunes can be made and lost in the blink of an eye. And given the fact that 50 to 60% of orders are executed by computers, all within a stone's throw of a stock exchange, it's nearly impossible for humans to gain a competitive advantage. But real estate is different. It's slower moving. There's no computers buying and selling in microseconds. Real estate is also much more fragmented, typically because there are millions of individual sellers. In real estate, there are the human and emotional elements that can be manipulated to gain a competitive advantage. And I use the word manipulated in a good way. For example, an owner can rehab a property, change out the paint colors, add landscaping, and stage it all to appeal to the emotional side of buyers. In essence, owners can effectively force equity into an investment property to raise the value, all with a bit of hard work. And I'm not going to cover all the aspects of the rehab process. I'll leave that for another podcast on another day. But try doing that with a stock or a bond. So investors need to use these different levers to our advantage. So now I'm going to pivot and briefly discuss some of the macroeconomics as it relates to interest rates and the price of homes. When I first got started on my investment journey about 10 years ago, it was a much different world than it is today. And you may recall we were just exiting the largest financial collapse since the Great Depression. This one was called, of course, the Great Recession. Housing prices were extremely low, interest rates were at historic lows, and there was an incredible amount of inventory to choose from. And you know me, I love quoting Warren Buffett, and I'm going to paraphrase here, but he said, if I had a way to buy a few million single-family homes and I had a way to manage these homes, I would load up on them. So I took his advice along with some advice from some of my mentors, and I began buying as many properties as I could. And I wish I was able to buy even more because they've been the best investments I've ever made. But at the time, it seemed a bit risky and scary. I didn't know how long it would take the U.S. to dig out of a staggering economy and regain strength. I didn't know if all that open inventory would convert renters to buyers. And I certainly didn't know if the value of the houses that I had just bought would fall even further after I acquired them. But I had a plan, and it was a risk that I was willing to accept because I had a long-term horizon. These weren't properties that I was looking to flip. They certainly weren't stocks that lost 20% of their value overnight. I was looking to keep these investments for the next several decades, and I was able to lock in 30 years of fixed interest rates to be able to, keep market fluctuations at a minimum. So again, I know we can't go back in time, so let's fast forward today. The good news is that interest rates are still at historic lows, but From everything that we're hearing in the news, the Fed is poised to continue the taper, which simply means that they're going to speed up the timeline of reducing the bonds that they're buying. In fact, analysts estimate that there's going to be at least 6 to 7 interest rate hikes between now and 2024. And this can have a staggering effect on the economy. Why? Well, because if it's now more expensive to borrow money, investors will have less of a return. And even, more savvy investors, they're going to have to simply increase rents to offset the losses, or they're going to find other opportunities altogether. But as interest rates climb, there are some natural side effects. So, number one, there's just going to be simply less selling of properties because any new loan will cost more in the future. And that's a tough pill to swallow, even for homeowners, right? So if you go from a 3% rate to a 4% rate, this isn't a 1% change. This is a 25% change. So investors and homeowners will simply hold on to their properties for a longer period of time because they will most likely have already locked in a better rate, potentially for the next 20 to 30 years. And, again, from a macroeconomic perspective, let's not forget that the housing market is roughly 18% of the overall economy. And so this has huge consequences. So the second effect, which is actually one of the root causes for higher interest rates, is inflation. And this is why we're paying more at the pump. Our grocery costs are higher. Healthcare, education, and just about everything that's measured is higher. And this is all reflected in what's called the CPI, or the Consumer Price Index. Heck, in November alone, we saw an increase of 6.8% in 1 month alone. So things are getting more expensive. So the other challenge that investors face is that we're competing with first-time home buyers for that same starter home inventory. And what we've seen over the last 10 years, really since the Great Recession, is that approximately 10% of the inventory is gobbled up year over year by investors. And this has caused there to be much less inventory leading up to today. The simple supply and demand tells us that when there is less supply combined with artificially low interest rates, the end result creates home prices to rise. So to put this in perspective, today there is roughly 384,000 available properties on the market, compared to a more normalized amount of roughly 1 million homes. Then, of course, there are other factors. COVID and the work from home theme has been in place going on 2 years now. And instead of moving, people are just putting additions on their houses. The second factor is what I like to call shadow inventory, which are all of the houses that never actually hit the market. And this may be due to wholesalers that buy directly from owners that never even list their properties. There's also builders that never list their properties, since they are building them for the specific purpose of selling properties to large publicly traded companies like Invitation Homes and American Homes for Rent. In essence, the builders don't want to build starter homes anymore because they're just not as profitable as larger homes. But if they are going to build, they're going to build an entire neighborhood for the direct purpose of offloading them to Wall Street firms or large institutional buyers. So, is this fair for first-time home buyers? Absolutely not. But, we can't worry about this. We can't necessarily save the world. So instead, we need to align ourselves to be successful investors. And so the window is closing. It's time to get started or continue buying prudent income-producing properties. But I know some of you out there are worried about a bubble. Everyone's asking, are we in bubble territory? Should I hold off? Are housing values going to deflate over the next several years? Well, maybe. But I'm not worried about this either. I continue to have a long-term vision for my portfolio, and I continue to acquire deals that make sense the day I buy them, and I'm not waiting to time the market. But For the sake of argument, let's catastrophize for a moment. And let's say that you do buy a property today and prices drop. Let's say they drop 20%. Are you going to sell that property? No, you're going to hold that property for cash flow. You're going to continue to put money in your pocket for the next several decades. You continue to get mortgage pay down, and you continue to get the best tax advantages of any investment in this country. So people that are waiting for a correction, they're going to be waiting a long time. And while they're waiting, hopefully they're not waiting too long with cash, right? Since inflation is eroding away at the value of that cash. But while they're waiting for conditions to be perfect, we as smart investors are getting wealthier. So in short, it's really hard to time the market, whether you're looking at stocks, bonds, or real estate. There's a better approach because there's opportunity costs associated with waiting, and the biggest loss is the loss of time. You know, as I said before, I wish I could go back 10 years ago and acquire 100 properties, but I can't. That window has closed. So don't let this window close on your opportunity to get started on your investment path today. And if you're seriously considering investing, why not invest in yourself and become a professional? So I highly encourage you to sign up for Stacking Houses Academy, where you can learn the step-by-step process that Jim, my business partner, and I took to grow our multi-million-dollar businesses. And here's the best part. Today, through the end of the year, we're having a holiday sale where you can get Stacking Houses Academy for 50% off the retail price, which is normally $9.97. Today, it's only $4.97. But just like interest rates and other things that I just spoke about, that window is closing. So Jim and I really want you to go into the new year ready to make a real impact on your net worth and cash flow that flows into your bank accounts every single month. So check that out at stackinghouses.com. And as I say at the end of all of our podcasts, a shameless plug. If you like what you heard today, I would appreciate a like, a share, or a review, or even share this podcast episode with someone that is in your investment circle. But continue listening. I encourage you to give us a thumbs up because it really does help some of us little guys that are just getting started on our podcasting journey, and it helps other house stackers find our great content as well. So as I mentioned at the beginning of the show, I want to give you, our listeners, our guide, our beginner's guide to getting started in real estate, which outlines all of the key steps that investors need to take to acquire your first property. And you can pick this up simply by going to stackinghouses.com/beginner. And until next time, happy investing, my friends.